All right, so a very good afternoon from a rather hot UK here. Thank you very much for attending, and thank you very much for your time here. As you can see here, the title of this presentation is Exploring News Trading, How to Trade Key Risk Events. My name's Aaron Hill, and I am the Chief Market Analyst here at FP Markets. So look, guys, I assume all the sound and visuals are coming across loud and clear, and you can see the welcome slide. Look, I am going to try and take things from the PowerPoint presentation to the charts, to the calendars, so it's more of a hands-on presentation this afternoon. So yeah, assuming you can hear me loud and clear, and it's coming. The visuals are all good, so we'll continue as usual. Look. Here's a quick disclaimer. Look, derivative products are highly leveraged, carry a high level of risk, and are not suitable for all investors. Though suffice it to say, the following presentation is considered educational, educational material only, and is in no way, shape, or form to be considered as investment advice. A quick summary of today's presentation. Look. If you're new, I'm assuming some of you are new to news trading. So I have to take it from the very beginning. We'll kick things off with a look at the economic calendar, how to read an economic calendar, the previous, the consensus, and things like that, and then we'll move on to, as you can see here, unlocking trading opportunities, how to navigate news trading. Because I do know this is quite a complex way of, I say complex, but it's really not once you understand the process, how to navigate news trading. And the most important really is answering why and when to enter a news trade. Look, I'll give you a quick preview of that. Why is where the macros really steps into the frame. It tells you why you're entering a certain trade, and when comes from your technical analysis. So in order to be more of a complete trader, I always say that you should have a good understanding of, especially if you're trading FX. I'm talking from an FX background here, guys, because that's primarily what I focus on. So why comes from your macros, and when comes from your technical analysis. Then we'll have, sorry about that. Then we'll have a live Q&A session at the end. But look, do feel free to fire across any questions you have during the presentation if it relates to the what we're discussing at that point in time. So unlocking opportunities, how to navigate news trading. Look, when news comes out, I'm sure you've seen it. You'll often see an increase in volatility, right? This is where price attempts to find a new equilibrium. So it's attempting to find a new fair value, if you will. Before I get started, it's important to understand, in order to reach a level of consistency trading news, it does require that you read. It does require that you understand the economic landscape that you are in. This is something we will touch on, but ultimately it's down to you to do the work and to read and to find like-minded traders to bounce ideas off of. Unfortunately, news trading is not as simple as waiting for better than expected or worse than expected data and simply trading the associated currencies. I wish it was, but it's really not as simple as that. Become proficient. So to become proficient, it is important that you have what's called an edge in the market. One has to fully immerse themselves in their markets of interest. So, for example, how I started my, if you will, macro journey is I focused on one or two currencies and their respective countries, and worked from there. So initially I started with the US dollar and the pound. So I focused on the US economy and the pound, because if you look at all of the big players in the markets, they normally specialize in certain areas of the market. So US economists, European economists, and things like that, they specialize. So in order to have a more all-round understanding, I always recommend to start off slow, understand one economy, understand one currency, and move on as such. So I'm, as I've said, primarily focused on the FX market, and this is really what I did to begin. We know that FX is a liquid market. It's the most liquid market in the world, I believe. It's the largest spot market in the world. And the barrier to entry is incredibly low to access this market, albeit this can be a detriment to the unprepared. Volatility, even with the major currency pairs, is also relatively good. But be aware that volatility is not constant and tends to increase following the release of tier one risk events or news. You can dig a little deeper in terms of volatility at metrics like implied volatility. And this is essentially how much the market expects price to move and it's based on options pricing. This is quite a large subject and one that could be better, I believe, better suited to for another presentation if there's interest. As I said, by learning about one or two markets to begin with, I know we all want to jump in and trade all of the major currency pairs. While you can do that, it's almost like the jack of all trades. I think jack of all trades, master of none. There we go, something like that. I always think about it like in that sense. So I prefer to start off slow, as I did with technical analysis. I started off slow. I mastered one, then moved on to another and another and another, and built my database, if you will, that way. So by learning about one or two markets to begin with, you'll be able to familiarize yourself with short-term patterns and longer-term support and resistance zones in those said markets. You'll also become familiar with volume by the time of day. You will often find a pickup at the opening of a cash session, for example, the London-New York overlap in terms of the time zones. You'll often see liquidity and volatility pick up at that point, which for me, being in London, is between 2:30 p.m. and around between 4 to 5 p.m. So ultimately, you need to understand the economic landscape you are trading. It is very, very important that you understand this and you understand the narratives of which are in play. So what do I mean? What do I mean by narratives? So a narrative is essentially the market stories. It's the market stories that are being told to you. And this blends really nicely with fundamental analysis. Just bear with me a minute, guys. I want to turn this. Worries. So yes, that narratives and fundamental analysis often blend very nicely. There are often multiple different narratives at any one time, some of which compete with each other, but there's always one dominant narrative in play. And this is very important to recognize. So the next question is, how do we find the narratives of the market? This requires work and reading, guys. Read as much as you can about the markets you trade. So, for instance, if you're trading the US dollar, if you're trading the US dollar and the pound, as I did to begin with, focus on those. Read the central bank. I know it sounds a bit boring and a bit dull, but the more you learn, the more you understand, the more exciting things become. So read what the central banks expect. Read their guidance. Read about their forecasts. Understand who is on the board. So, for instance, for the UK, we have the Bank of England, right? We have nine voting members on the board there, and with the Fed, we have 12 voting committee members. This is something you need to understand. So read the central banks, read their guidance, understand, and follow when you'll often find central bank speakers speak to financial media news outlets. This is very important. You need to understand who's hawkish and who's dovish. To become proficient, I also recommend finding a or developing a pool of like-minded people who trade similarly. Now, this can be tough at the beginning to find people like this, but I believe it is very, very much worth the time. And to be honest with you, I used to trade primarily from a technical analysis background. I was a steadfast technical analysis. I completed the CMT program. I was I still am very passionate about technical analysis, but I always felt like I was missing something. I always felt like I was trading not so much blind, but I was just missing something. And really, macroeconomic analysis really opened the door to me. Really opened the door to a new understanding, a new way of trading, and it allowed me to blend my technical knowledge very well. You can find experts as well. This is what I did. I found experts in macroeconomic analysis who trade the same markets as you. And if you can get their hands on their write-ups, so their analysis, that will help a lot. Now, AI, in the world of AI that we are in now, does a fantastic job of summarizing these reports. So it's certainly something to be aware of, because these reports can be like 30 pages long. If you want to read through all of that, fantastic. But I use AI to summarize the key points, and it does a fantastic job for me. To become proficient, figure out what the main drivers of your markets are. For me, it's fairly simple. It's the central banks and it's the key economic indicators. It's growth, GDP, it's inflation, and it's the jobs market. Another thing I really want to point out here is correlated markets. I'm sure for anyone that's been in the FX market for more than a year will understand that markets are correlated. We are living in an interconnected world right now. And, so for instance, if you're trading the Aussie dollar, you should know that it's considered a risk on currency and generally rallies when equities rally. If you're trading the dollar CAD, you need to know that there is an oil component to that. So, for instance, if one of the drivers surrounds the price of oil, this could influence the Canadian dollar and by extension influence the dollar CAD. So you need to be aware of all of the correlations for your said markets. So the goal, of course, is to try and determine which narrative is driving the markets right now. So right now, one of the major narratives for me is Trump, of course, Trump and his tariffs. Although it's very, very tiring to keep up with. Look, another narrative for me is the Fed. It's clearly the Fed and the issue with the possibility of a shadow Fed chair entering the frame. Now, if we imagine that, we imagine a shadow Fed chair entering the frame, and we have Jay Powell also in the frame. We have two voices almost competing for each other, and things could get very messy. Who do we listen to? Do we listen to the new shadow Fed chair that Trump selected to enter the frame, or do we listen to Powell, who exits the frame next year in May? So these are key components to be aware of. Inflation is a key element right now because of tariffs, right? So it's like it's like a side effect of tariffs, because inflation is expected to increase in the US, but we're also meant to get disinflation outside of the US. Growth is meant to take a hit. So again, growth is a key driver to be aware of. What is key to understand about these narratives is that they often, not always, but they often change course prior to price action, because let's face it, as humans, as human traders, we tend to overshoot. We tend to what's the best way I can describe this? You may, if you've ever studied any financial textbook regarding investing, you may have come across the behavioral biases. I think I did a webinar about this many years ago. You may recall the term confirmation bias. So what happens is it's a psychological phenomenon that in which we favor information that aligns with our pre-existing beliefs, and we tend to shelve or overlook contradictory evidence. And in the context of trading, this this bias, if you will, can significantly skew our decision making. And look, to really boil it down, or the nuts and bolts of it, is we tend to overshoot. We tend to keep going, even when the narrative has changed. So this is something to be aware of. So narratives are incredibly important. So narratives are what's driving the markets. You only have to turn on Bloomberg, the Bloomberg financial, the live TV. You'll hear about the narratives because they're often talking about it. It's Trump, 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 and of course the Fed. And look, I'm sure you've seen Donald Trump was out on social media recently, and uh, it's quite insane what the markets have turned into. We have to focus on what Trump says, and his changeability has made it very, very difficult. I will touch on a risk event that was incredibly tradable, the July payrolls event, and this was like a breath of fresh air for any risk event traders or news traders, because we have had quite a difficult time in finding finding suitable trading opportunities based on news, because of how complicated Trump has made the situation through his tariffs and his changeability and the uncertainty. Look, if you are going to change, if you are going to trade trade news, you need to understand what is priced in, what's expected in the markets. This is critical, and it's essentially what markets and economists expect to occur. Now, I will just switch things over to the calendar, as I want to touch on how a calendar is presented. I'm a big fan of the trading economics calendar. I know a lot of traders, a lot of retail traders are more drawn to the Forex Factory, and I was at the very, very beginning of my career. I do hope you can see this, guys. I'm just going to, yeah, there we go. So this is the calendar for trading economics. It's very basic, and it's a free calendar, right, as you would expect. So to the left, we have the time, the time, and here's the date of the the news events that are out. So we have news events from all around the world. We have Australia, we have Japan, we have Korea, we have Indonesia, we have the UK. Pretty self-explanatory, the calendars, guys. We have the time, we have the currency or the country that the economic event will potentially affect, and then we have the actual economic data. Now, I don't see this on here, but it's not as clear as Forex Factory. But the potentially high probability, that the high impacting events are labeled as in red. So you'll see this on the calendar. So here you can see the euro area inflation, US non-farm payrolls, which is something I will touch on very shortly. So yeah, it's pretty self-explanatory, but here is where things get interesting. Actual previous consensus. I'm not sure why they do this, a consensus and forecast here. I'm not sure, but you'll find on many. So with the consensus prints, you'll find on Forex Factory as well, these are the median estimates. With these free calendars here, you'll only get access to the median estimate, the middle point of. So you have a distribution of economist estimates. You'll have the high at the high end of things, and you have the low estimate at the low end of things. But right in the middle is where you'll have your median estimate, and this is what you'll have access to on these free calendars. As you can see, there's not much you can get from this. These trading economics is pretty quick in terms of releasing data, but I'm going to now transfer over to this is a paid, this is LSG data, Refinitiv. And as you can see, it's a far more technical, and it offers a lot more information. So for instance, again, we have the date. This is the 1st of August, guys, because I'm going to talk about the non-farm payrolls event later on. But so we have the non-farm farm payrolls. We have the potential impact. So it's a high market impact, the 3 bars here. And as you can see, we have the Reuters poll. The key thing about these paid for calendars is it provides you with the minimum and maximum estimates, as you can see here. And this is really key because it gives you if you're trading news, you want to know what the maximum estimate was and the low estimate was within the economist's distribution. If you understand that, and if we get a data point that falls outside of this zone, we know we have a strong surprise in the market, and these are where the solid trades can take place. Now, I'm not sure if there's any free calendars that offer the minimum and maximum estimates. I do believe Refinitiv offer a cheaper version of the Refinitiv package. I think that's done by MetaQuotes or Metastock, I think. And they may have added the maximum and minimum estimate. I can't be sure, but I think it was like $100 a month or something. But you have got some out there that do provide this as a service. But if you're serious about news trading, you need to get access to the best calendars, and you need to get access to these minimum and maximum estimates. As you can see, 176, this was the high. So the median estimate, the Reuters poll was 110,000, but the high of this was 176,000 and zero. This was from someone from Santander, and I will go over this, as I said, shortly. But this is the nuts and bolts of a calendar. You don't need to go into too much here, but the calendar is what as its name implies, it provides you with a list of scheduled economic data that you must follow. So if there's no questions about the calendars, guys, I will switch back to the slides and we'll work from there. All right, so look, what is priced in? As you saw there, pricing in means what are economists estimating. So the non-farm payrolls was 110,000. This is what is priced in. You also have the interest rate probabilities. I'll show you that later, but with Refinitiv, you have access to. So if you primarily focus on the US economy, you have access to Fed funds futures data through what's known as the CME Group FedWatch. Just Google that and you'll find a very easy to read diagram regarding what the futures markets are implying for future meetings for the Fed. This is what's priced in. This is what markets are expecting. Look, as a quick example off the top of my head, the July RBA meeting was, I think it was the July, yes, the July RBA meeting. I'm sure for anyone that trades the Aussie dollar will remember this. The July RBA meeting was widely expected to cut rates. I think it was like they were fully priced in for a 25 basis point rate cut from 3.85% to 3.6%. But it surprised markets and did not cut. And given this data release, given the surprise of this is what we look for as traders. What do you think will happen when literally everyone was expecting the RBA to cut? There was probably a few outliers not expecting a cut, but the majority were expecting the RBA to cut. This created a surprise. And what you'll find when the markets deliver a surprise outcome, market participants have to readjust their positions. And this is where you'll find all that volatility, all that price change as the price action attempts to find a new equilibrium. And following the announcement of the RBA holding rates, we saw the Aussie dollar rally nearly 1%, almost, I think it was in the first 5 minutes. And this is where you can take advantage. This is where you can make good money. I mean, I've been at the one end of the technical spectrum where I'm trading, technical analysis. I'm trying to think of the way I used to trade. I used to trade off long-term levels, but try to look for shorter-term patterns and things like that. I used to try and combine many technical indicators, and I did do very well. But this far surpasses anything I've ever looked at, and there is plenty of information out there from leading banks leading desks that provide pretty much free information of what their desks are looking for and how they're planning their trades. So there's a lot of information out there. But yes, so what is priced in? This is something you really need to understand if you're going to trade news. Look, buy the rumor, sell the fact. There are two ways of trading news. In my opinion, there are two ways of trading news. There is trading out of risk events. This is my favorite. This is what I rarely trade any other way. So trade out of risk events. Then you have trading into risk events. And this is essentially buy the rumor, sell the fact. So I'm sure many of you have already heard of this. Even if you've just begun your journey in trading, it is essentially, as the title implies, you effectively buy the rumor prior to the release of the data. And then you sell the fact, you sell the outcome of the event. And this can really catch, for those who are not paying attention, this can really catch a lot of traders off guard. Look, imagine a scenario where let's use the RBA again as an example. And let's imagine that the central bank, the RBA, begins introducing the idea, say they begin introducing the idea in March, that they will cut rates, that they're planning to cut rates, or they're looking at the possibility of cutting rates. This will trigger Aussie dollar downside immediately, because they've shifted from whatever bias they had before to a potentially a dovish bias. So imagine the next meeting. You see, and then you see policymakers suggesting easing is even nearer. What do you think will happen to the Aussie dollar? You'll see a continuation to the downside in the Aussie dollar as traders price in that event, as traders expect the RBA to begin cutting rates. You'll likely see a trend there, and this is where you can start to use your technical analysis. You can start to sell those rallies in the downtrend from the Aussie dollar. So there's a good saying, right? When you're trading macros, the central bank creates a trend, which it has done here. It's created that trend of the Aussie dollar for the Aussie dollar, and you then use the economic data to trade out of those risk events and use technical analysis to enter and exit. Look, I'll go over that very shortly. So what you have in this case are traders selling the idea that the RBA will cut rates. They're essentially selling the rumor that the RBA will ease policy. What happens when the RBA does cut rates? Would you expect a solid move to the downside? So imagine all of these traders that have sold this rumor. They're going to cash out of their positions. And if they cash out of their short positions, they're liquidating their short positions. This becomes a buy order. So what you'll see is the RBA actually cutting rates, but the Aussie dollar rallying. And this can catch a lot of traders off guard. It's caught me off guard when I was trading technical analysis many years ago. And it makes no sense, right? Because if the RBA cuts rates, you expect a solid move to the downside, but this was priced in. One thing I would say is, if you're considering trading into risk events, is to cash out of your position prior to the actual outcome. I just don't see the point in trying to cash out of the event when the RBA does cut rates. I just don't see the point of that, because slippage will be high and you'll be paying a lot more to get out of your position. What's the point? You might as well get out of your position in profit before the event comes about. So as I've said, I much prefer trading out of risk events. This is where I believe the higher probability trades are found. Why and when to enter a trade, right? This is where we get into the nuts and bolts of things. So for those of you who know me well, will already know I was a steadfast technical analyst who went far beyond the basic terms of the basic understanding of technical analysis. And really, my goal was to understand as much as I could about price action and how it moved and how I could potentially take advantage of this. I always thought the economic side of trading would be too complicated to use, even though I knew traders were making money from trading economics, but it always seemed so esoteric, if you will. It just seems so complicated and something I just, when I first began trading, I was my mentor was a technical analyst. He made very, very good money. He still does. And I was brought into the trading arena through technical analysis. But as I've said, I've learned to merge both macro and technical analysis, and it's provided me a completely different lens to look through in regarding the FX market. Now, don't get me wrong, as I've said, you need to study. But once you understand the narratives and understand how to read the economic calendar, understand how to read the economic data as it relates to the central bank's bias, as you understand positioning. So positioning is something you can look at as well. When I refer to positioning market sentiment, I'm looking more at the CFTC data, the COT data, the Commitment of Traders report. You can really get a good idea. And all this data is available on TradingView as well. You can actually have the data at the bottom of your charts. And this really helps. I think I did a 3-part series on positioning data, commitment of traders. I think a 3-part series articles where I showed how you can find overstretched and overstretched markets to the upside and downside. And this is where you look to try and catch the point where traders begin to unwind their positions based on a fresh economic catalyst from economic data. And this is where you can really catch those solid moves. Now, as I've said, this is by far the most superior way I've found. And if you would have said this to me 10 years ago when I was trading technical analysis, I would have probably shrugged it off. However, I've been proven wrong, and including macroeconomic analysis into my trading was key to take things up a notch. Now, I'm not saying you need to go and study for an economics degree. I'm not saying that you need to go and study for a finance degree. All of the information is available online. That's a great thing about the internet now, and it's a great thing about YouTube and things like that. You can find all the information online if you put the work in, and it really is worth it. So in terms of trading, and I'll show you a chart very shortly, I rarely trade the news immediately. Now, the July non-farm payrolls data would have been an excellent opportunity to trade immediately because I couldn't find an entry. I just could not find an entry following the data. The only problem is the spread can be diabolical at times following the release of a tier 1 risk event. I find personally it's just so much easier for me to wait, evaluate things. When I say wait, I'm talking about a minute or two. Wait, evaluate things, and look for my technical levels. I tend to keep things very simple. I tend to look for a break of support and then a retest of that support. And these retests happen relatively quickly, and you can get in where the spread is lower and the risk to reward is greater, in my opinion, anyway. Where do news traders place their stops? Now, this is something that was quite complicated for me at first, but if you have the technical knowledge and you wait until the risk event has been released, you can then apply your TA to the charts and analyze as such. But if you're sorry, if you're going into the market immediately, so you've got to expect higher spread, what you can do is use a level on the chart called a news pivot or something like that. This is where, so for instance, if the non-farm payrolls was released here and prices move down here, up there is your pivot. So if price goes above there, the trade is over. So we've gone above there, above that point, your trade is over. So you may as well place your stop just above the pivot if you're going to enter the trades at immediately after the event is released. It's also very important to look for, so when you're looking for trading ideas, how to trade an event. So for instance, you look at the maximum and minimum estimate range, which I showed you for the non-farm payrolls. You look at that, and then you look for the cycle highs. So for instance, if I'm just looking at the data here, if we did indeed get 176K print for the non-farm payrolls, if we blasted through that and got 203K, that would look, I'm off the cuff here, but if that was a new cycle high as well, this is new territory, and we'll likely see a bid in the dollar and yields, for example, and potentially weigh on equities. So you need to plan, you need to pre-plan every trade before you enter, as you would with technical analysis, right? You'd plan your entry, you'd plan your stop, but you'd also, if you're incorporating macro into your trading, you need to plan how you are going to approach this, because in the thick of things, when the event is released, things do move very, very quickly. So you need to be prepared and planned for the event. How do we know what data to follow? Good question. This is something I never really understood. So if you understand the current narratives, so for instance, Trump's tariffs, you know it's inflationary. You know there's potential inflationary pressures on the back of this. You know growth could take a hit. Follow the central banks. The central banks tell you what economic data they're following. So take the Bank of England, for example, who recently cut rates by 25 basis points, but the MPC vote split was considered hawkish, so it was considered a hawkish cut. You'll see in their guidance that they are now focused mainly on the labour market. So any labour market data, excuse me, guys, they're focused on inflation. They're focused on inflation. So the Bank of England are focused more on the inflation side of the mandate. And this is something that you need to focus on. So if the central bank are focusing on this, you know when the UK CPI data comes out, you know if you get an outside deviation from what is expected, things have changed, which means traders will have to go into the market and readjust their positions. And this is where you look to take advantage. So for instance, if we get a better than expected print for US, I'm off the cuff here, guys, but for instance, a UK CPI beat, and we know positioning is overstretched to the downside, what do you think those positions are going to do when that new catalyst enters the arena? They're going to start unwinding those short positions, and this should add pressure to the upside. And this is where you want to be. This is where you want to trade the highest probability trades. Look, to make this simple, let's move things over to the charts. I'm just going to get things sorted. I really want to look at the US CPI, again, the US July CPI, excuse me, guys, the US July payrolls data. So here we go. All right, so just really quickly bring up that calendar again. And just to give you a, here is the interest rate probability. So for instance, we have the Fed now. So the Fed are expected to cut rates by September. This is widely available for free on the internet. So this is the Fed Funds Futures Guide. So you can go online and find, just as I said, type in CME Group FedWatch tool, and you'll find all of this data. You'll find that they're fully pricing in a September rate cut. And for the year, as you can see, up to December, they're pricing in 61 basis points, which means, you know, if they go in 25 basis increments, just over 2 rate cuts for this year, which is pretty much consistent with what the Fed projected in their last SEP. It's just something to be aware of. So we're looking at non-farm payrolls data. As you can see, we had some really, really punchy revisions in the data, and this is really what drove the market's reaction. Let me just bring up this data so it brings a little bit more. Let me remove those revisions. All right, so as you can see, 73,000 for June was the payrolls NFP, and prior to that, we had 139,000. Now, if we add in the revisions for the data, so this is where data is revised as more economic data reaches the Department of Labor. They then revise their data. But look, so you can see the revisions here for May, excuse me, guys, for May and June. So the revisions for May, this was, as you can see here, the revisions were insane. They were revised lower by 125,000 from 144,000 to just 19,000 there. For June, we saw a revision down by 133,000 payrolls from 147,000 to 14,000, and this was the revision for the June data. If you look at the report, you'll also see, based on a 3-month average, uh, payroll the US economy added 35,000 jobs on a 3-month average. This reflects a considerable slowdown in the jobs market. And look, the Fed has has a dual mandate, right? It has the employment data and it has the inflation data. Now, to see employment take a hit, we could be looking at a potential recession. I'm not saying we will, but a potential recession. Growth can take a hit on the back of that, and this could lead to the Fed cutting rates, which is what we're all looking for, is when the Fed will cut rates. And what you saw with this move, you saw this happen. So this is the move. This is a 1-minute chart, guys. This is the news pivot there. So 1:30. This is 1:30 UK time there, guys. This is your news pivot just there. So if you waited 1 minute to enter that trade, so 1 minute is quite a long time if you've planned before that trade and you know those revisions were punchy, this and reflects a considerable slowdown. We also saw unemployment rise to, I think it was 4.2%. This was expected, but we still saw unemployment rise. Look, we had a softening jobs market, and this really did drive things home. So we saw a strong move to the downside in the first minute. This is the algo traders coming into the market. And as human traders, we really can't compete with this. But after a minute, you should have your ideas locked in. And you could have potentially entered at this point here with your stop above here. I'm not sure what the spread would have been at this point. It would have been pretty tasty, I would imagine. But you had all of this downside to work with. I personally know a number of traders that took advantage of this move. Now, if you're like me and you'd rather wait instead of entering at these levels, just off the cuff, just get in as quickly as you can with your stop above the news pivot. You can wait for, I'm not sure if any of you guys have seen my previous webinars where I looked at support and resistance levels like IQMs. So I found that, especially during news events react very, very well to IQMs. So these are inverted Quasimodo levels. So they are, as you can see here, a low, high, lower low, and then a high. And what you'll see is a clean break through these levels. So you'll often see a clean break through these levels and then a subsequent retest. And this is where I'll look to get in. This is where I'll look to sell the rally and place my stops somewhere above this level. I won't be looking at the news pivot if I'm looking at these levels. But on this occasion, I just could not find anything. As you can see, IQM here, we saw a small reaction to this level, break to the downside. I just could not get sell any rally. We had another, let me just go to the 5-minute chart or 3-minute chart here, so it might be easier. I just could not. So I had another IQM here, nothing, blew straight through this level. Another IQM here. I mean, it was just too messy at this point. So we blew through here. We did have a minor reaction here, but this wasn't clean enough. I like to see a clean break and then a subsequent retest of this resistance. And by the time you trade this level, the dust would have settled a little bit, but the sentiment will still be to the downside. So I look to take, I'm trying to think of a saying right now. I like to take the, take the 25% of the move if I can. So I look simply to break these levels and retest them and trade. And the good thing is the spread will be much lower at that point. You won't have to deal with those 40 pip spreads I've seen on some trading platforms, which is pretty insane. And you'd need to obviously rally 40 or drop 40 points or 40 pips before you're even in a break even, which is pretty insane for me. And I just don't feel comfortable with this. Yes, so this is the main way I look to trade, IQMs, but you can also look at things like the monthly and quarterly open levels. So if you have an open level here and we break below here, any support and resistance really will work. You could use dynamic support and simple moving averages. This is the beautiful thing about this method is you can factor in your macroeconomic analysis, and then you can use your uh, technical framework to enter the market and place your risk. And this is key. Will you get opportunities every day? Most certainly not. Will you get opportunities every month? You should do in normal trading conditions, but with Trump complicating the waters, it can be quite tough to find opportunities. But being flat is often a better trade. It's often, you know, over trading, these without overtrading and not respecting your plan and not taking those high probability trades is a way to ruin your account and really mess with your psychology. Because as we know, guys, analysis and psychology is a key thing with trading. And I believe being flat, if you're not sure, stay out. Simple. There'll be another bus along. Um, so the good thing is you don't have to follow the way I trade. You could look to enter straight away a minute after, once you've assessed your position. And this would have been a very nice trading opportunity. I mean, I'm just trying to look here. There was nothing at this point here where I would have entered. There was just nothing for me, unfortunately. So this is the key, how I trade and how I look at the markets now. Um, are there any questions, guys, on this? So the key really is you look for the central bank, you just read about what macro traders are doing. Read the central bank's bias. Read what the central bank speakers are looking at. Read about the hawks. Read about the doves. And look, you can even get good trading opportunities from comments when they're speaking to financial news outlets. So you really need to be on the ball if you're trading this way. But the great thing about trading news is you don't really need to be at the screen all the time. If you're just trading news, you just need to be at the screen for your news event. As long as you've done the prep, as long as you've planned, as long as you understand the narratives, as long as you understand what the effect this economic indicator could potentially have on the markets, then you can just bear with me, guys. I'm just reading the questions here. Sorry. Um, so I'm just reading one question here. I am going to read it out. What central banks do I look for in US, the Fed Reserve or JP Morgan Chase? So JP Morgan Chase it's an investment bank, it's a commercial bank. So what you'll want from JP Morgan Chase is their analysis. These banks have really great analysts on their desks. So this is where you'll get these kinds of reviews of the market. Central banks for the US is the Fed, the Federal Reserve. Just honestly, guys, type into Google what is the Fed. It will show you. It will give you a detailed framework of who's the Fed governor, Jay Powell. Who are the voting members? Because there's actually, I think it's 19 members, but only 12 of them. I think 12 of them are voting members. Understand the structure of the Fed, the Federal Reserve. Understand their meetings, understand their guidance, understand when they release their forecast. They release them every quarter. It's called the Summary of Economic Projections. And this can be market moving and really all connects, all blends together when you're trading these economic indicators. You cannot just come into the market and trade the beats and the misses. This is a surefire way to risk of ruin. So your account will blow up eventually, I believe, if you just do that. Can you give a link to where to look for central banks, macro traders' decisions? The links, look, guys, Google the central banks, developed central banks. This is where I would start. So the US, focus on the Fed, focus on the Bank of England. The European Central Bank is an interesting one as well. Focus on those, and that will have the guidance. In terms of macro trading, um, what do I look at? I am a big fan of the bank reports, so I look at the bank reports every day. Bloomberg is a fantastic outlet. Reuters, Refinitiv, look at their news. They offer free articles. Read about what their analysts are looking at. You'll soon get an idea of what's going on in the markets, and you'll be surprised when you step away for say a week or so. You'll be surprised how much you've missed and how it will take a day or two. That's for me. It takes a day or two for me to get to quote Mark Douglas, trading in the zone, to get back in the zone before I feel comfortable discussing macro trading again. So yeah, is it possible to enter the market before the event happens? This is a question here. Yes, of course. So as I said, there's two ways of entering the markets. You can trade into a risk event. You can trade into the event or trade out of the event. What I've just explained here is trading out of the event. So trading into the event is essentially the same as buy the rumor, sell the fact. You remember the example I gave of the RBA? If you know that if they've suggested that they are going to potentially ease policy, this can be a Aussie dollar negative, and you can trade that. You can trade on the back of that, and assuming they continue with that bias, you can then look to trade. You can look to sell those rallies into the event, and it's a nice way of trading. But I just prefer to trade out of risk events. It's much more organized. It's much more in out. So you're essentially scalping the markets. I was never a big fan of scalping the markets when I was focusing on technical analysis. But in terms of trading out of risk events, especially ones where they move like this and the NFP, there are fantastic ways of generating a good income from trading. Bear with me, guys. I'm checking the questions. Is it all right? So I hope that answers your question there, Roger. Where can I get microeconomics report like post news? So microeconomics is different from macroeconomics. Microeconomics is more of individual economic agents. So you're looking more at businesses and things like that. So I assume you mean macro reports. So look at Bloomberg. It's a free site. Look at Bloomberg. Read some of their articles. I think they offer like 3 or 4 articles that you can read for free. Look at the market wraps. Look at what the experts are saying about what's happening in the market. Who do I? Nomura Investment Bank. Nomura, Nomura podcast. Look at that. There's a week ahead podcast. It's fantastic. You've got these industry experts talking about the macro space. You have Bank of America. They put out free podcasts as well. MUFG Bank. They put out a weekly podcast as well. It's all available online. You just have to do a little bit of searching, and you'll have all of this data at your fingertips. I hope that answers your question there. What was the app when you were checking interest rates? Look, guys, let me show you something because the interest rates. I'm just answering your question there, Jason. The app, it wasn't an app. It was part of the Refinitiv package, which is quite expensive. It's quite an expensive package. But let me just show you the free version of the. Bear with me, guys. Let me just share my screen because this will show you. I'm surprised. I think I'm sharing the screen now. Yep, there we go. So this is the CME Group FedWatch tool. And as you can see here, look, target rate probabilities. So you can see, remember what I showed you from the Refinitiv interest rate probabilities. It was almost fully priced in for next target rate probabilities for the September the 17th meeting, 94%. And if you remember, it's fully priced in. And what you can do is you can go out. So you have the September meeting. October meeting. So if we go right to December, I believe that we will be looking at what we're at now we're looking at around 50 basis points. So the target range of 3.5% to 3.75% is the highest probability right now. So we are looking at around two rate cuts this year, according to the Fed funds futures market. So look, just do a quick search for this, and this shows you'll find a lot of retail brokers use this data as well. You'll normally find that they take a screenshot of this and they put it on their analysis, and it's the same. It's the same. The only difference is I also for the RBA. Let me just show you the RBA, because RBA rate tracker, I think it's called. There we go. RBA rate tracker. So this is what you'd use for the RBA, for the Reserve Bank of Australia. Another one, another free. There we go. So for the next meeting, we are looking at. So what are we at now? So we're looking at around a 50-50. So as of the 11th of August, it's still at a 50-50 bet between a no change and a decrease to 3.35%. You will recall that the RBA cut rates this week, right? They cut rates by 25 basis points to 3.6%. And look, we're now at a 50-50 probability that the RBA will cut again. So that's a decrease to 3.35%, 25 basis points. So it just takes a little bit of research, guys, and you can find all of this data online. I hope that answers your question there, Jason. Do you think technical analysis is enough for trading, or should we focus on fundamentals or economics as well? This is really up to you. This is really a personal thing. For me, technical analysis was definitely enough. Depending on how you handle what your mindset is like. I mean, it goes for everything. It's the same. How you manage risk as well, because it's not just all about chart analysis. It's how you handle your mindset, how you handle losses, how you handle wins, and how you handle being wrong. Anyone that's traded has been wrong, and it's how you handle that. It's how you handle being wrong, and it's how you handle your risk. If you have a loss, if you have two losses in a row on the day, do you go in and revenge trade and lose, another? It's a vicious cycle. It really all depends. For me personally, I do prefer combining technical and fundamental analysis, macro analysis, because I like to keep things simple. FX is simple for me. Stocks, there's hundreds and hundreds of stocks. You've seen the earnings season, right? We have stocks releasing data every single day. For me, FX is something I can focus on the major currency pairs, and I can really deep dive into how those economies work and how the currencies should move on the back of that. So to answer your question, I do think it's enough. It depends on the person. I know plenty of traders that made money. I made money from technical analysis, but I always felt, as I said in the presentation, that it really wasn't enough. Some people really do, for lack of a better word, they laugh at technical analysis, but it really is such a key component, I believe, how advanced you can become just by reading price action. And it's not just simple moving averages crossing over. That's the very, very basics. The 50-day simple moving average crossing above the 200. Anyone can trade that. Anyone can trade a line crossing another line. It's ridiculous. But you can really deep dive into technicals and find an edge, I believe. When you were talking about the NFP, you were on the app checking the historic data and projection. Yeah, that was on Refinitiv, Jason. Again, that's a paid for calendar. These are quite expensive. I'm not sure. I think you can get that on the economic. I'm pretty sure there's got to be something out there that does show you when you say projection, I assume you mean the median estimate. You can get that on this calendar here as Friday the 1st. You can get that here, non-farm payrolls. This is the consensus, 110K, as you saw on the Refinitiv calendar. It's all about, it's the median estimate. You rarely will find the high and lows. I do remember seeing one calendar offer this, but for the life of me, I can't remember where it was or what it was, and it was free. But as I said, I just can't remember which calendar it was. But there has to be some out there. There has to be. Um, so I hope that clears up all of the questions there, guys. I hope I answered them all. If there's anything, I do hope this presentation did shed some light on a new way of trading. We hope to be doing more like this in the future. But if you have any ideas for future topics you'd like me to delve deeper into, please do send them through. As you can see here, you can send all your comments and feedback to marketanalyst@fpmarkets.com. Any questions you require a deeper, more of an in-depth response to, please do feel free to reach out to the team there. One of the analysts will get back to you, or I will. If there's no other questions, guys, thank you very much for your time. Enjoy the rest of your day wherever you're located. And yeah, thank you for joining us. And that's it for now. Thank you.